3 weeks ago, I was speaking with a founder. His name is Abdul. And for the last 2 years, he has been trying to raise funding for his health tech startup, but all to no avail. And as usual, he blamed it on tough market conditions. The market is tough and a lot of people are not able to raise. Investors are not actively writing checks. But quite interestingly, he has gotten on several calls with potential investors, and it seems as if after each call, none of them want to have further conversation with him. As I decided to probe further, I discovered that some of the important performance metrics that will help him to communicate the traction that his business has seen and the future potential of that particular business, that Abdul was struggling to communicate some of them. Because I also agree that it's quite a sea of several metrics that you need to hold up in your head. So in this particular video, I'm going to try to narrow the list down into those very important ones that you need to know. In this video, I'll be covering about 13 different metrics that you need to master that helps you to communicate your business performance better. Also, for simplicity, I've tried to group them into three different categories or three different buckets. The first one being customer focused metrics, the second one financial health focused metrics, and the third one investment and return focused metrics. So in the subsequent sections, I'll be breaking down each of them further. All right, starting with customer focused metrics. Now, customer focused metrics tend to evaluate how well you're onboarding customers and the sort of engagement that the customers are having. Investors are very critical about the customer focused metrics because definitely customer is king. If the customers are not getting value from your platform, if the customer base is not growing, then the business is not going to grow. So on that note, there are four different customer focused metrics that I'm going to be discussing. So the first one is customer growth rate. Aside from reporting that you have 30,000 customers on the platform, you have 20,000 users on the platform, investors are very much concerned about how that has been growing over time, especially for early stage startups. It's expected that because you are launching out, that your customer base will be growing at double digits. You'll be experiencing fast growth. And if there's anything that investors, venture capital firms are very much concerned about is high growth rate. So if your platform is growing at a very high growth, it means that it has future potential for them to see outside returns from your business. So the second one now is customer acquisition cost. Yes, that your platform is growing, but how efficient are you when it comes to acquiring new customers? As expected, when you are still launching out your product, you are still trying to onboard new customers, your customer acquisition cost is going to be high, especially in this time of social media marketing, digital based marketing that is getting more and more costly by the day, even though it's still more cheaper than the traditional based media sort of advertisement or sort of promotions. But then, in as much as it's expected that it's going to be high at that initial stage, but investors want to see that your customer acquisition cost is declining over the years. That as you keep on onboarding new customers, that your customer acquisition cost is going to decline. For also another reason, because this tends to help them to judge network effect. Now, network effect is that as more and more of your customers that you are bringing on board on the platform, those customers use their hand to like attract other customers on the platform. And network effect is just more like your platform having an exponential growth once you start having more and more users come on board the platform, such that the users tend to attract other people on the platform. So once you start seeing network effects on your platform, one particular marker that shows that is that your customer acquisition cost continues to decline and investors love it. Then the third one I'm going to be talking about is customer lifetime value. Customer lifetime value is very much important, and especially it also helps you to judge whether it makes sense for you to pay such amount of money in order to acquire a new customer. And customer lifetime value is also very, very critical for businesses that operate in the B2B model, whereby you're going to spend maybe 6 months or 8 months trying to onboard a B2B client on your platform, or you're going to spend like about $5,000 or $10,000 in order to acquire that particular B2B customers on your platform. Because unlike, let's say, B2C, where you're spending doing more of your marketing on social media, for B2B, you most likely be incurring travel costs, you going to be incurring other logistic expenses that tend to scale up the cost of acquiring that B2B customer. But your customer lifetime value tends to help it make sense why you should spend that amount of money in order to acquire that particular client. So let's say, for instance, you acquire a client this year and the client is going to stay with you for, let's say, 10 years. And in that 10 years, every year, they only get to make a purchase once in a year. And the value of that purchase is about 1 million naira. So their customer lifetime value for you is now 10 million naira. The question now is, does it make sense for you to spend 88 million naira trying to acquire that particular customer, or sometimes even exceed the 10 million naira in order to acquire that particular customer? So placing your customer acquisition cost side by side with your customer lifetime value helps it to make sense why you should spend that amount of money. Then also, customer lifetime value tends to give the investor an indication how the sort of impact that that customer is going to have on your revenue. So that's for customer lifetime value. The last one I'm going to be talking about when it comes to customer focused metrics is the churn rate. So the churn rate is the rate at which you are losing customers, at which customers are dropping off from your platform, or they stop using your services. And this is also a very important metric, especially for software as a service platforms, whereby most of their business model is based on subscription. So if you have more and more people refusing to renew their subscriptions, dropping off after their initial subscription, it tends to show that perhaps the pricing points are quite high, or maybe the platform is not giving the customer enough value, and that is why they have to leave. So your churn rate is a very, very much important metric. And again, if your churn rate is anywhere above 10%, then it doesn't really show good customer engagement on your platform. So you want to be able to keep it somewhere less than 5%. That is usually an acceptable number, bearing in mind that for every customer that you tend to lose, it also impacts on the revenue that you are able to report at the end of the day. So those are the four aspects when it comes to customer focused metrics. So the next one I'm going to be moving into is the financial health focused metrics. So how well have you been performing in monetary terms, right? So the first one is monthly recurring revenue, or annual recurring revenue. So the emphasis there is on recurring. The emphasis, again, I'm going to say it is recurring. So investors are very much concerned about what is the recurring revenue that your business is generating. They don't want to see too many volatility in terms of the revenue that you're making. That's, let's say, this month you're making $100,000, and then the following month you are down to $5,000. The upper month you are down to about $7,000. So it tends to, that sort of volatility tends to show instability in the business, right? So the investors are concerned to know, okay, on an average every month, what is the sort of recurring revenue that business is going to be able to see. And this is also very particular for software as a service platforms that tend to use, let's say, subscription based models. So that recurring revenue is very, very critical. And also, some businesses may be thriving on contracts. So this year they will have like a government contract that bumps up revenue to about $1 million. But that could be very deceitful, because that contract may not be renewed in the following year, and then revenue is down. So the investors want to know what aspect of the business revenue is recurring. Then the other one now is your revenue growth rate. And obviously your revenue growth rate is what percentage month on month growth, or year on year growth in revenue that you are seeing. And to a large extent, that is going to be influenced by, let's say, the new customers that you are onboarding. So if you're onboarding customers at double digits and those customers are actively transacting on your platform, it's definitely going to affect the growth rate of your revenue as well. Then the other one now is gross margins. Your gross margins is very, very important, and it's just an accountant term for looking at, okay, if you serve a particular client and you make revenue from them, you serve a customer and you earn revenue for them, the direct cost that is associated with serving that particular client is, when you take that out of your revenue, then you get your gross profit. So your gross profit now helps you to know what is the sort of gross margins that you have. So it's typically your gross profit divided by your revenue. So that gives you an indication of, okay, what does it, when you serve a particular customer, how much you are able to keep. So the higher your gross margins is very much important because it means that you have more leeway in order to cover for your operating costs. And what tends to be a balanced gross margin is very based on the industry. So there are certain industry like say let's say software as a service, their gross margins tends to be higher because their cost of sales is very minimal. It costs them little or nothing to serve a software to an additional customer. Unlike another company that does, let's say, medical devices, for instance, whereby you have to incur manufacturing costs and all of the other material costs. So for you to be able to serve one more customer, you have to incur the same amount of the same cost when it comes to the raw materials that you are going to be putting into that product. So investors are very much keen about startups that tend to have higher gross margins because it means that the startup is going to be capturing more value for every customer that they serve. Then the third one when it comes to evaluating financial health is understanding the burn rate of your business. Now, every investor understands the fact that at that very early stage for a startup, that they are going to be burning more cash, usually more than they're able to generate from their operating activities, but they want to see that the burn rate is within a reasonable level that allows the startup to have enough runway to get to their next funding round. So for instance, if you have raised $100,000 and you are burning $10,000 on a monthly basis, what that means is that you have just 10 months of runway before you are out of cash and then you are back into the market to raise more money. So investors want to understand your burn rate. So you should be able to communicate your burn rate properly. And then the other one is now your runway. So like I mentioned, runway is how long that your existing cash reserves is going to take you based off on how you are burning cash. So you want to be able to ensure that you have enough runway to get you to the next milestone before your next funding round. So investors will always want to understand that part of your business. Then the last part of the category I'm going to be talking about is investment and returns focused metrics. So investment and focus metrics tend to give the investor an idea of the sort of returns they are going to be getting from your business when they eventually decide to exit, right? And also factors around how much they are going to be paying to get a share in your company. So the first one when it comes to investment and returns focused metrics is your valuation, understanding the value of the particular company, whether understanding the pre-money valuation. So what is the valuation of the company before they put their money in, and when they put their money in, what is going to be the post-money valuation? So investors want to ensure that they are not overpaying for your company, because if they are paying for the company at a very high valuation, it's going to affect the sort of returns they are going to be getting at exit. So the second part is now EV to sales multiples. Now, unlike let's say in corporate finance or in the corporate world whereby a lot of DCF valuation based methodologies are used to value equities in that particular company, it doesn't really apply that much when it comes to startup based valuation, right? Because of the uncertain future cash flows that the startup will tend to have. So what investors then typically focus on is to see how many times the revenue they are going to use as the valuation basis. So that's what we talk about by the EVs to sales multiples, taking the which is basically taking the revenue of the company and then multiplying it out to see, okay, what is the valuation of the company. So let's say, for instance, most VCs are increasingly adopting, let's say, 10x of revenue as their valuation cap for any particular startup. So if, for instance, a company is making revenue of $1 million, now that means the valuation cap for that particular venture capital firm that tends to follow 10x of revenue is going to be $10 million. So these are some of the metrics that investors are concerned about. So you've said that this is your valuation. How many times of revenue is that particular valuation? Then when we talk about the expected multiples on invested capital, so investors want to make some sort of educated projections as to how many X of their investments they are going to make when they invest into your company. So whilst this may be uncertain, but in order to communicate confidence, to communicate the fact that you've given thought about the sort of returns that the investor is going to be getting, you may want to make some sort of educated projections as to, okay, when the investor waits to, let's say, your Series A round, this is what you expect your valuation to be by your Series A round. That gives, let's say, by the next Series A round, let's say the investor coming at seed, and by your invest by your Series A round, you expect that your valuation should have gone up by, let's say, two times or three times. It means that if the investor wants to exit at your Series A, they are going to be getting two times their capital. Also, something else you may want to do is to look at comparable companies that have perhaps been acquired within your space, right? And then you're able to make some sort of projections as to all things being equal. This is the sort of multiple on invested capital that your investors stand a chance to give to gain, because they are not there for charity, they are there to make money, right? So you want to communicate that your business is quite a viable one for them to look into. Then the fourth one is now your capital efficiency. Capital efficiency is very, very critical, and investors are very big on it. So capital efficiency is basically looking at, based on the capital that you've raised so far, how well have you used it to capture value? How well have you used it to make more revenue? So, for instance, for every $1 of investor capital raised, how much dollar in revenue have you been able to generate? And investors tend to use capital efficiency as a way of comparing between two investment that they want to make. Let's say they want to make investment, they want to make a decision between two different telemedicine companies that they would like to invest into. So sometimes capital efficiency can be a basis to say, okay, telemedicine company A has raised $500,000, and out of that $500,000, they've been able to generate $250,000 in revenue. So what that means is that for every $1 of investor capital they've raised, they've been able to generate 50 cents in revenue, right? So that's like $0.5. But on the other hand, let's consider another particular company that has raised $1 million, and out of that $1 million, they are making $250,000 in revenue, right? Whilst they are the same revenue range for the two companies, but the first company is more capital efficient when we look at how much they have raised versus how much they're able to generate in revenue. So you want to be able to track your capital efficiency and report the same to investors. It's going to really give you a step forward. So that tends to wrap it up for this particular video on crucial metrics that you need to know before you get on a call with a potential investor. So if you found this video very helpful, please do well to hit the subscribe button, turn on your notification. More videos are yet to come. Thank you very much.